Hello and welcome to the December edition of my market newsletter. I just keep finding, of course, over this year as well, there's just an abundance of noise and confusion in the financial markets, and really I find most people don't know how to cut through the noise and really get and find the data they're looking for to make informed decisions. Because of this, I've created this monthly newsletter where each month I put together a summary of thinkings to help educate long-term decisions. So with that said, let's get into it. So from the end of the financial recession, March 2009 to January 2022, the S&P 500 enjoyed compounded returns of close to 17%. So put another way, if you put $10,000 into an IRA investment, it would have been roughly $70,000 over that same period of time, a 7x return, okay? But since January 2022, we've had a rapid increase in inflation, followed by an incredibly sharp increase in interest rates by the Federal Reserve. Well, the result, we had a bear market in both stocks and bonds. The S&P 500 dropped about 25% in the following 25 months, and the 10-year Treasury bond was down about 15% during a similar period. This 15% in bonds made the unfortunate history as being the worst year for bonds ever. And you can see on this chart here how this panned out from January 3rd, get myself out of the way, January 3rd to December 31st, 2022. And of course, don't forget about the war in Ukraine, coming close to 2 years since Russia first invaded. And the war in Israel and Palestine, along with Iran getting closer to nuclear capabilities. And also, don't pass over the material fact that Iran continues to poke and prod at the U.S. and its allies. There's at least or close to 40 times since October 2023 that Iran has attacked the United States. You can see here, and you can read more by going to this article here. And really, in a personal view, it seems that Iran is really just hoping for a broader U.S. conflict. And personally, I kind of think this is just as a means to distract us from Ukraine and Israel. And really, at home, things don't appear to be all that much better with the southern border, looking as though it really just doesn't exist. Crime and homelessness in some U.S. cities have gotten so bad that retailers are moving out of certain areas. I wrote about this more in my last month's newsletter. And that the U.S. budget deficit continues to soar and march down a path that does not appear to be sustainable. The same is true when it comes to Social Security and Medicare. And somehow there isn't enough political will, at least not yet, to do anything about it. All this along with an upcoming presidential election. So now that I've thoroughly depressed my readers and listeners, let me ask a question. Given the non-exhaustive list of things I just mentioned in the past close to 2 years, would it surprise you to read that the S&P is down just 1.2%? From January 3rd to December 5th, the S&P 500 is down just 1.2% over this period of time. It sure feels like that number is a misprint. At least it does to me. And it sure feels like the market would be down a whole heck of a lot past 20 to 25%. But it isn't. So what I'm getting at is that there's some kind of disconnect that's happening here. Something really isn't adding up. And that over the past calendar year, and I've had more of these conversations than ever in the past 15 years I've been in the financial industry. So really, what might the broader know that we normal investors don't know? Well, the answer to this question is something we can only really make educated guesses. You see, no one on earth has ever proven themselves to be an excellent predictor of economic outcomes. And really, if there was such a person or firm or company or group, the reality is that probably all of our investment dollars will be managed by this entity or group. There's always been, and I assume there's always going to be, an unlimited number of views and predictions about the future. All of which are, of course, unknown because the future is unknown. And it seems that most people do have a crystal ball, but your crystal ball, if you have one, is probably like mine in that it's either broken or cloudy or really just plain wrong. And so with all the negative news, both foreign and domestic, here's my strong conviction and where my hope for future investing lies, in that we do not invest in governments. We do not invest in politics. We invest in broad, large, diversified, scrutinized, publicly traded companies that are profit-driven for their shareholders. People like you and me. These companies realize we can change our investment in these companies at almost a moment's notice. So all these companies realize that if they stop providing value, we'll simply take our investment capital elsewhere. We don't owe anything to these companies. In fact, because they have our investments under their care, they owe us. I want to make sure I'm connecting the dots on this because when you think of the broader market, it's made up of these companies I'm referencing. And these are effectively the same companies that were down close to 25% on average in 2022. And for a slew of whole different reasons, these companies are on average are now back to where they were about 2 years ago, even with all the negative headlines and unknowns about the future. And if these companies lose their way or fall out of alignment or just stop providing value, we'll just simply change our investment to a different company that is aligned, with a profit motive. And well, to me, this is one of the most beautiful aspects of broad market investing. It's the faith and conviction that the world will not end. And when it does, or whenever that does happen, really your money won't matter anyway, neither will mine. But that global economic progress, the belief and faith here is that it's going to continue to advance just as it has over the past thousands of years. And that our belief in this is so high is that we're willing to put our hard-earned dollars behind these companies to innovate, create items, and create a profit that will be returned to us shareholders. So that I'll close this part by saying Merry Christmas. Now, each month I do get asked by clients and prospects and other readers what resources I'm looking at. And as always, please hear me in saying I'm not looking to make any prediction. But there are some things I think are worth noting. One is now, it's 13 months old. There's a blog post from November 2022 where I made the argument that we may have just hit bottom. That this bottom point here that we had, down roughly 25%, was probably going to be it. And well, it just continues to see that looks like I might have been right on that. The next item that I want to look at is going to be oil and oil exports. It's a surprise that most of us that the U.S. is the world's largest oil producer. And there's actually 48 super tankers headed to the U.S. for oil export. The next data point that I think is interesting is looking at this 5.9 trillion. Get myself out of the way again. 5.9 trillion in money markets. This is at its highest level ever reported. There's 5.9 trillion in money market funds. And in the investment market, for like inside baseball talk, this is called dry powder. These are dollars enjoying, currently, higher levels of interest than years past. But I want you to ask yourself, what do you think will happen when or if the Federal Reserve starts to cut interest rates? And then in turn, banks start paying less in interest on these accounts. The question is, do you really think people will just continue to hold their funds with less interest? Or do you think they'll look for other alternatives to make money? My guess is that, and assuming interest rates do come down, these people will start to move these funds back into the broader market. So if that happens, what do you think is going to happen with market prices if this does occur? Something to think about. Another data point is looking at the Bureau of Labor Statistics. This is something I've been tracking for, maybe 2 years now. And you can see the peak here back in March of 2022. Things are really leveling out. The next data point is going to be looking at the 5-year inflation rate. This just continues to tick further. I'm stopping tracking the M2 level as it relates to inflation. Some long-time readers are aware of this chart. My point that I was trying to prove then that they're correlated is simply proven that they are absolutely correlated. I just don't see a need of putting it back in here. And then the last one is going to be looking at the Federal Reserve balance sheet. And this one is encouraging. Because we have this, of course, increase here with the financial crisis back in 2008, 2009, and then this steady ramp up, and then COVID hit, and then we had more ramp up, and then we started to come down. This increase here was Silicon Valley Bank, and then we're coming down again. But the thing that does give me encouragement is that from the peak here to where we are now, we're down about $1 trillion in Federal Reserve assets. Okay, and this is all done with intent because in May 2022, the Federal Reserve came out and said, hey, we're looking to reduce the balance sheet, and then they were going to accelerate it in June to August. It's about $95 billion a month. And they're coming through it, and they're going through with it, I should say. So this does give me encouragement. There's certainly a really, really, really long way to go here to be able to unwind this. But all things to be said, very encouraging movements. So in closing, I realize it's December, and so I do hope everyone has a fantastic Christmas, holiday season, and Happy New Year. And of course, we cannot control what the market does from here, and we cannot predict when the next market downturn will occur, like in 2022. But what we can control is our behavior to these outside events and continue to stick with our long-term investment plans. With that, if you have any questions, don't hesitate to reach out. Have a great day.